Hey guys, Boris Schlossberg from BKT. Good to be with you again. We're going to do the third and final installment of my How to Scalp Successfully series. Going to visit some of the trades that I did this week, show you the good and the bad and the ugly. But before I get to that, I want to address one very important thing. First of all, as you see, I am trading this particular strategy on my Oanda account. Why do I do that? Because generally I prefer to trade GFT. GFT is my company and it has a much better dealing engine. The one and only reason why I trade Oanda is because it marks my trades. There have been several people who have accused me of cherry picking the charts, that I'm sort of trading after the fact. Nothing could be bigger lie than that. It's absolutely not true. As you can see, the reason why I'm trading Oanda is because Oanda marks all of these charts up. Every single trade is marked with a little red circle for a stop, a green circle for a limit, and an entry exit with triangles. And that is the reason why I want to show you that when you look at these charts, you see how many red circles there are? Clearly, not something that I'm cherry picking. I am trading this real time, real money, real markets, specifically because I want to show you that it works in real time. So anybody who challenges me on that is full of crap, and you can see it in the charts themselves. Now, I want to get on to the actual trading strategy again, show you where it succeeded, where it failed, and some of the adjustments that I made, and some of the analytics. As I went back, I think the key thing here is I made a deeper, more analytical version of where this thing works better and best on. First of all, this is the euro-dollar chart. Now, you know, we all, let me review the rules of the strategy for those of you who are new. On a 5-minute chart, when we have two candles that are above the 2 standard deviation Bollinger Band, like right here, we would get short, or conversely, if we get two of them below completed candles, below the 2 standard deviation chart, we would get long, with a couple of exceptions. And those exceptions being that we try not to get short or long in front of the big figures, like 000 or 5000, or the half figure, and obviously, we let the price action go through the full 5-minute time cycle. This is a strategy that is traded in time as well as in price. And time is a critical aspect of it, because the key thing here isn't to simply look at price levels, but to look at the move as it exhausts itself over a period of a 5-minute time frame, and then hopefully try to get it back. Now, the reason why I chose this particular segment is because this is yesterday's euro-dollar move. And of course, as you can see, it's moved from 3,500 to 3,700 against the all the quantitative easing that the Fed did. And of course, if you're looking at this fundamentally, the much more natural strategy is to get long euros. And as many of you know, when we were trading the BKT long-term signals, we were actually short dollars through dollar Swiss, because that was our trade. And of course, we stayed in this trade for a long time. The difference is, this is not a strategy you're trading fundamentally. This is a strategy you're trading statistically. What you're trying to do is capture very, very small profits against very, very small risks as the trade moves and retraces, moves and retraces. And it's within these extreme moves that you have the highest probabilities for retraces. So we have a couple of trades in the euro here where you see, I took this move, which was very dangerous, by the way. I took the 77, I think, and I brought it right back, buying it around 65. The key thing here is, again, the strategy involves 10-point risk against a 7-point profit target. You take your profit targets and go, because a lot of times you're going to get the continuity of the move. Now, what's interesting here, by the way, is remember I was telling you that we trade this strategy through time and price. Here's an example where I got very, very sloppy. I didn't let the full candle complete. I basically tried to front run. This thing extended so much that I decided, prices moved so much. This is a very big danger with this strategy, is that you start thinking about price instead of time. Then I'm going to get short before the candle completes. And of course, boom, got stopped out once, got stopped out twice before the candle actually completed. And I had gone into it on the third time, and of course that was a much more successful trade. Right? Here's another example where I was a lot more patient. I let the candle sort of complete here, and then went into it, and was able to catch up a small move. But the next thing I want to show you is the fact that when I was trading this, I was primarily trading this on euro, yen, and pound. And one of the things that I noticed about the pound, of course, let me just pull up the pound chart here for everybody to see. Okay. This is a 15-minute chart only because the charts don't go back on a 5-minute basis. But what you see of the pound is, one, it's an extremely volatile pair, right? And two, the spread on the pair, especially in Oanda, which is a wide variable spread, can be as much as 5.5 points wide in early Europe, late Asia session. When you have a spread that wide and you're trading with a 10-point stop or even a 12-point stop, you're setting yourself up for failure many times. So as you see here, I get stopped out, I make a little money, I get stopped out. It becomes a very, very volatile proposition. I decided, hey, you know what? I'm going to stop trading the pound completely. I'm only going to focus on the euro and the yen because I want to see less volatile returns. Now here's the interesting thing. When the whole dust settled and I took a look at my equity curve, let me just show you the full equity curve. The equity curve was actually quite good. This is the equity curve for the last 2 weeks. And as you can see, a little bit of a grind. I start to basically master the strategy. I go into a stall. And this is basically the trading for last week. We have some retraces, relatively sharp retraces on the spikes. But overall, the equity curve, especially over the last 3 or 4 days, certainly been nothing to sneeze at. That's a very nice looking equity curve as you're trading. Now this is for all three pairs, yen, euro, and pound. So the irony of the whole thing is that I stopped trading pound about midweek through the week because of volatility, thinking that really the pound was not going to be a very big contributor to my positive equity curve. Now what I did now is I just extracted everything but the pound equity curve. And this is the pound equity curve. And ironically enough, as you can see, the pound actually was a pretty nice, good net contributor. Yes, there were relatively big spikes, and especially this kind of a spike. That's a very big volatility retrace, right? I mean, here's the high, and you actually break the high of the previous move before you recover on the pound. So the pound clearly is a much more volatile strategy, but net, overall, it's a big positive contributor, so you have to consider it. Now, what I did then is I simply took a look at the equity curve without the pound, just the euro and the yen equity curve. And as you can see, the euro and the yen equity curve is really, really very tight. So the retraces are very controlled. The moves up, making new highs in equity continuously, are well done. And I think if you're looking for a risk-reward fusion, this is probably the right strategy. Despite the fact that the pound was a net positive contributor, the volatility function of the pound was just too much if you're looking for a smoother, easier, more stable equity curve. I mean, this is really, for the last 3 or 4 days, certainly been a damn good equity curve out of the euro yen. So one of the things that I kind of wanted to stress is that not only do you want to trade the rules of the strategy, but you kind of want to do the analytics afterwards to see what is really working, where your suspicions are correct, where your suspicions are false, because all of it is very much resident in the data. The main thing is we take our stops very tightly, we take our profits very quickly, and we time our trades. The key thing is it's a strategy of trading both through price and time. And again, as you can see, it's been a net positive strategy for me in all real-time situations on my Oanda account. The next step is I think I'm going to trade this with a much larger position because it's proven to be, I think I've done about 150 trades on this thing already. And the total amount of, as a matter of fact, let me just tell you exactly. I did 200 trades in the strategy since 2 weeks ago, and the strategy has been plus 180 pips positive. So it's certainly not a huge home run strategy, but what it does is it is a very consistent 10 pips a day strategy, which is something that I strive for in my intraday scalping. So I'm wishing you the best of luck. I hope you've enjoyed this particular strategy. I'll keep you abreast of what's going on maybe 2 or 3 months forward. Any questions, please email me. This is Boris Schlossberg for BKT. Over and out.